This conference will now be recorded.
Good morning, everyone. Thank you for joining us on our weekly call. A little bit of housekeeping. You should be able to speak if you have called in on your phone line. If you are on your computer and listening through your computer and you want to ask a question, you can enter it into the chat box. Otherwise, you'll have options to speak if you just unmute your phone. And with that, I'll give it to Rob so we can stay on time this morning.
Thank you, Allie. Good morning. Today is the Bob and Rob show. Bob Petkoff and Rob Beatty are going to be conducting our call. I'm going to get us started, dive right in. Today we're going to talk about, first off, we're going to touch base on multi-year guaranteed rates. Currently, for a 3-year multi-year guarantee for $100,000 or more, our top rate is with Minnesota Life at 3.05%. Our top 5-year rate is still with American National at 3.55%. But I have to tell you that rate is dropping on 3/1, and down is the trend line in interest rates right now for MYGAs. It's going to drop to 3.4%, not a small drop, effective 3/1. So if by some miracle you can get a case written today and overnighted, they need the application ASAP. As in tomorrow, to lock in the higher rate. So as after Friday, it's 3.4%. Our top 10-year rate is also with American National at 3.75, going to 3.6% on 3/1. Our top S&P 500 accumulation 5-year fixed index annuity has got a cap rate of 6.5%. That's our highest cap rate on a 5-year S&P year-to-year point-to-point, 1-year point-to-point, I should say. And our top 7-year product is currently with Symetra at 6.4% and at Protective at 6.1%. This is all for deposits of $100,000 or more. Now, I want to say that those are not black and white, clear-cut solutions. The highest cap rate is not necessarily always the best solution. Please reach out to the annuity design team if you think you've got an annuity solution that you're looking to take advantage of. Let us do some case design work and optimize the outcome for your client. We also have our single premium immediate annuities, and right now our top 2 companies coming in are Lincoln and Minnesota Life are at the top of the heap. That changes literally weekly. So again, if you've got clients looking to turn on income, reach out to us, give us the specifics. We'll run the analysis of the available carriers, show the top payouts, and as well we will be taking a look at our new American General product. It's kind of displacing a lot of the SPIAs for income in the right age solutions. So that's our rundown on our...
Rob,
yes.
Can I interrupt real quick?
I can breathe now.
I went on Bankrate.com this morning, and the top 5-year jumbo CD on the internet is 3.1. And the top 3-year is 2.85. So factor in that a lot of our clients aren't necessarily shopping the internet for jumbo CD rates and are going to their community banks for interest rates far lower than that. And so a 5-year MYGA, I would guarantee, will, even at 3.4, will exceed CD renewals at 2, 1.5, and the client can control the tax when they want to pay the tax on the interest. So turn it back over to you, but I just thought I'd butt in with an update on what the competition might be or where they fall short.
Yeah, you know what? We can eliminate a 1099 moment for the clients as they accrue interest in their CDs, as well as paying out better rates. So better rates, tax deferred, avoid probate, all the benefits of taking a hard look at using a simple fixed annuity. Our 1040 moment for today is looking at line 9 on the 1040 and talking about the qualified business income deduction. If you have clients that are on a threshold or getting, are they going to qualify? There's clear income thresholds on the AGI as to whether or not you can qualify for this new qualified business deduction. And there's 2 potential solutions there. If your client already has a pension, SEP, or defined contribution plan, we should let's do an analysis and see, is there a way through adopting a different structured plan where we could increase the amount of contribution that the employer, your client, the business owner, has going into the plan, or if they're a participant in a plan, that's going to eliminate the qualified business deduction. And then also, if they have other income coming in from investments, does it make sense to put some of that income generating portfolio into annuities to reduce their AGI so that they might qualify for the qualified business income deduction? Again, let's do an audit of their existing plans. If they don't have a plan, let's take a look at putting a plan in place for them. And again, even a moderate-sized census does not mean that we can't get the majority of the contributions going to the business owner. Combining a 401k, new comparability profit-sharing plan, along with a cash balance or traditional defined benefit plan. And our life insurance audit. If you have clients out there that have whole life policies with internal built-up loans inside of them, we have a loan rescue strategy through some of our product providers where we can loan rescue whole life policies. And again, whole life policies, the clients get a wake-up call from the carrier saying, if you don't start contributing money to this policy, we feel it's going to lapse in the next few years. Oh, and by the way, the taxable event's going to be in the six figures. And the client's like, I never took money out of my whole life policy. How did that happen? Like, how am I going to be taxed? I put money in, it lapses. How do I get taxed? Well, through the magic accounting of whole life, dividends that are paid into the policy reduce cost basis. And then when the loan mechanism starts to cycle out of control, you can go down to a zero cost basis in a whole life policy in no time. And how does the loan start? Well, they were shown a 10-year Vanish premium. Well, in most whole life policies, if that Vanish is not guaranteed, and even if it is guaranteed, the way it's done is through an auto loan process that takes place inside of the policy. So if you have clients out there where and it can be done with loan to cash value ratios of 80-20, 80 loan, 20 cash value, we might not be able to guarantee the outcome, but the one thing I know we probably can do is kick that date out. So let's say they're being told that they've got this 80-20 loan and that policy's in jeopardy and it's only going to last 5 more years. Well, what if we can move that date out past life expectancy, or at least defer that outcome? So again, if you have clients that have policy loans on them, and in many cases in whole life policies, they may not even realize it, we need to look at a loan rescue solution and see if we can't prevent that catastrophe from happening. And next, we're going to address asset-based long-term care solution, and I will turn the conversation over to Bob. Bob, how's the weather in Fort Wayne?
Oh, it's beautiful. It's always sunny in Fort Wayne. One thing real quick about the loan and the phantom income and the surprises of 1099s. I was talking to a First Global CPA advisor last week, and he said that he had a client get a love letter from MassMutual for over $200,000 was the phantom income on a whole life policy that was surrendered. Actually, it was several corporate-owned policies, so not a pleasurable thing. There may have been a solution that we could have helped with. What I wanted to talk about today is we just talked about non-qualified annuities and how wonderful they are, but sometimes the client has a tax time bomb ticking that he's going to pass on to his kids or her kids, and so we have a strategy for non-qualified annuities to convert that tax deferred into a tax-free LTC benefit. There are annuities that are Pension Protection Act approved that you could 1035 an annuity in. So let's look at an annuity that has a $100,000 basis and a $250,000 gain. We have a $350,000 annuity, and $250,000 of it is taxable. That could be 1035'd into a Pension Protection Act friendly LTC annuity and provide long-term care and some significant leverage. Each case is individual. One America has a product where we could cover both lives on the same annuity and provide 2 buckets of long-term care. Anything that's paid out for a long-term care benefit is tax-free. The mechanisms of that are pretty simple. They'll pay out basis first, and then the interest. Anything that's left passes to a non-spouse is taxable, obviously, and could be spread out, could be stretched. Two of our carriers that have these products, Lincoln and One America, both will allow you to, so let's say it was a $500,000 LTC annuity, and we only needed $250 for LTC. We could do a partial 1035 into the Pension Protection Act friendly LTC annuity and take the other $250 and send it to another investment product, obviously an annuity, and they would split the basis and the gain. So it's not an all or none thing. It's quite flexible. It's the devil's in the detail and in the design. But the bottom line is we can take tax-free or tax-deferred growth and turn it into tax-free benefits for LTC. And I brought that up on a call yesterday, and the advisor said, well, by the way, I happen to have a couple of those. Let me send them to you. And so we're in the planning process right now. Rob, that's all I got.
Thanks, Bob. I appreciate that. If anyone has any questions, you can unmute your phone. We're happy to take questions. So we'll take a pause here, see if anyone's got any questions or comments. Anybody got any successes for the past week they'd like to share, past 2 weeks? Any meetings they've had? It's interactive.
Everybody's asleep.
Well, all right then. We are at the 11-minute mark. We promise to keep these phone calls between 10 and 15 minutes during this busy time. So thank you, everybody, for participating. Look forward to talking with you next Wednesday, same time, same channel. The Bob and Rob Show will be back. Thank you for your time. Have a great week.